Good morning, everybody. Welcome back to the Flow Show after a little holiday break. Hope you're all doing fine and dandy. Good morning, lads. How you doing?
Oh, you said lads. Hey, clever. Good morning. Very
morning.
well.
How was the beach?
Very good. It's really hot now. We're going again this afternoon, so it's going to be a daily occurrence now.
God, hard life. Oh.
Well, I do have two young daughters with me, so it's not the easiest thing in the world, but yeah, it's cool.
We'll make the use of it. Yeah. Indeed. How you doing, K-Man?
Yeah, all good, mate. I'm not going to the beach this afternoon.
Well, you're invited if you want. You're invited. Come.
Yeah, be lucky to get in the garden, I think. Right, so we've had a little day off, a little refresher, so time to get stuck back into things. We'll kick off as we always do over in China. PBOC continuing to fix the midpoint lower, 7.1968. Expectations had come down as well to 7.21. Let's just pop that chart up there so you can see. So still applying the brakes, I'm going to call it at the moment, not putting a brick wall in front of it, but the market now may be sensing signs of a bit of a top here in terms of the price moves. We're holding around that former level 127.25 70s. I'm expecting this area 25s 28s to become a bit sticky again, but it's holding the support areas where it needs to, so I don't think the game's over for now, but going to be watching to see if we get a bit of sideways action here. The moves or their attempts to put a halt on mild weakness isn't being helped. The services PMI was out overnight. It came in at 53.9 versus 56.2 expected and 57.1 prior. So that data there giving further indication that there's still weakness in the Chinese economy, following pretty much a lot of what we've seen in the PMIs around the grounds so far this morning. If we start by looking at those, there's the China number there, as you can see, coming in softer. Also, Japan as well, a little bit softer, was expected to pull back to 54.2, came in at 54. Aussie as well, doing the same thing. The theme has been the same, as I say, all the way through the data pretty much everywhere this morning. Service sector's really seeing a decent pullback in some of the numbers. Spain as well. I don't need to go through the whole lot. I don't think you get the picture. Italy, France, Germany, Eurozone, UK, all similar patterns, although the UK didn't fall further than expected than the flash number anyway. PPI data from the Eurozone going into the negative for the first time year on year, and much more negative than expected. Something we've been talking about for a while on the show. We've been seeing negative month on month numbers. Now we're seeing negative year on year numbers. That in effect has a potential to accelerate the falls in inflation we've been seeing in many of the inflation components around the countries.
Ryan, sorry to interrupt. Just to let people know, just in case they've forgotten, this PPI year-on-year rate peaked above 40%.
Yeah.
6 or 7 or 8 months ago, whatever it was. So this, I think, can get a lot more negative and simply because of mathematics, right? I mean, the way if something goes up in a huge, scale in terms of rate of change, well, then all else being equal, it's going to come down in a big way. So this all feeds into inflation and et cetera, et cetera. Just want to put some perspective, basically.
Yeah, thank you, mate. Thank you. And yeah, it's when we see negative numbers, it's going to, as I say, accelerate the drops in inflation. If we ever start to see negative year-on-year inflation numbers, then we've got something to think about. But at the moment, it's just slowing the rate of increases. They could come down quicker. Obviously, whether the core follows as quickly remains to be seen. But if the pressure remains, then we are going to see those core numbers coming down eventually. And then we get to see what everyone wants to guess from central banks on the other side of the coin when they're going to start cutting rates. Some of the items I want to pick out for the UK services number, because input costs, although they eased, i.e. they weren't going up as much, there's still a big pressure from wages. So while firms saw energy prices and the like falling, they were countered by wage increases, which are still coming through the pipe. And that means that there's going to be some inflation persistence for the UK for a bit longer. I think the next inflation readout the UK is the 19th or 20th of July. So that's going to be a big one to watch for the UK anyway. Back to Japan, and the big Labour Confederation Rengo said that the average 2023 rate hike is 3.58%, which doesn't sound a lot, but it's the largest since 1993. If you think back, expectations were around 3.5 to 3.8%. So they're coming there or thereabouts. As we know from Kishida particularly, they want to see these wage increases coming in again next year. That will help with the inflationary pressures and hopefully get the Bank of Japan some leeway to end their easing policy. But that's also dependent on what inflation does for the rest of the year and their fiscal year. But a bit of a confirmation there about the size of the wage hikes there. RBA, they left their rate unchanged at 4.1% Tuesday morning, and that did leave the door open by saying some further tightening of monetary policy may be required. The whole decision is to give them time to assess the impact of past moves. Well, the last time they held it lasted a meeting, so don't know what these guys are going to be playing at. Monetary policy month to month or meeting to meeting, as a lot of central banks might be as well. Right, sorry, just come back to the UK as well. We heard from Sainsbury's CEO, that's one of the big supermarkets in the UK, saying inflation at their stores are running at half the headline rate that's in the market. So that's 7.9% headline inflation in the market. Their inflation is running at half that, so call it 4%. Still, that's inflation, so it's still prices going up, just not as much as they were prior. Did say prices are falling though in most areas where they went up the most, mainly fresh food. So stickiness still remains, at least in grocery inflation, as we've seen from the numbers. Over to the ECB. ECB's Nagel said September decision is to depend on new data. Then came out later on saying interest rates must rise further. It's too early to say how far, but he's wary of proclaiming a new era of high interest rates. So despite the hawkishness from the German central banker there, always ones for being hot on inflation, they don't want to see rates high or, as they said, proclaim a new era of high interest rates. So that gives you a sense that when interest rates have done their job on inflation, supposedly, they're going to come down maybe quite quickly. We shall see. ECB's Visco says interest rate decisions are taken meeting by meeting on the basis of incoming data. And then maybe points to a bit of a bum fight going on in the ECB's halls of power, saying, I don't understand and don't agree with those who prefer the risk of tightening too much rather than tightening too little. On the inflation front, an ECB consumer poll had inflation expectations for the next 12 months falling to 3.9% versus 4.1% in April, so coming down a little bit. However, longer term inflations, i.e. 3 years ahead, stayed unchanged at 2.5%, notably both above the ECB's target. Going back to the data for the US, because on Monday we did get those ISM numbers, we haven't had a chance to speak about, and also coming in soft, headline coming in at 46.3. Oh, sorry, no, that's the S&P Global one, 46.3, which was unchanged on the flash number, confirming the drop. The ISM came in at 46 versus 47.2, so was expected to go up 3 pips, and instead it came in 9 pips softer. It wasn't good for the rest of the components, depending on which ones you looked at. Employment fell into contraction at 48.1. On the prices front, which is good news for the Fed, that came down to 41.8, further into contraction there. So the US kicked off really, well, the manufacturing showed that that's looking weaker as well, as we've seen with all the other PMIs. We get the big ISM services tomorrow, on top of a load of jobs data as well. So it's going to be a big day for data trading tomorrow. Coming over to oil, and the Saudi energy minister is having an OPEC Plus conference in Vienna. Said OPEC Plus will do whatever is necessary to support the market. That's not a lot at the moment. They've had 2 production cuts, one which caused a gap up in oil back in April. Then another one we had which did naff all in the market, lasted about 5 minutes. Let's get that up for you. Let's go there. So there was the April move. Can't even see where the other one was. As I say, it lasted about 5 minutes before washing out. So their promises to do more or whatever's necessary isn't sparking any life into oil markets at the moment. Again, like a lot of commodities, I think this one is being depressed by what's going on in manufacturing, i.e. the slump in activity there. On the geopolitics, Ukraine Zelensky says Russia is planning dangerous provocations at the Zaporizhzhia nuclear plant. There have been some stories that Russians have lined it all with explosives and are ready to do some bad stuff there. We wait to see what happens to that, but it's something that may have been in the market's mind this morning. And just looking at the headlines, because Russia is out, or the Kremlin is out and talking about it. Let me just see. They say that the nuclear power plant situation there is tense, and the threat of sabotage is great. Consequences of possible Ukrainian sabotage could be catastrophic. So they're all playing games around this nuclear plant, which is obviously dangerous for everybody concerned. When Z went to meet Putin earlier a couple of months ago, he said that he warned Putin against a nuclear attack in Ukraine, and that helped Putin step back from that sort of threat. The Kremlin is happening to comment on that as well, on that report. So this was from the FT, saying that they cannot confirm this. So they're not saying anything about that one. But things heating up around there. Keep an eye on those headlines. Guys, you got anything? Oh, well, I know Stellis hasn't got anything because he probably wasn't looking at headlines while building sandcastles. Kay, you got anything you want to check in the mix today?
I have not seen much else than what you are talking about on the headlines, mate. No, I'm just note that Yellen is about to set off to go and visit Beijing. I think it's she's off, like, is it tomorrow, right? Tomorrow she's traveling to China. If I recall correctly, for a 3-day trip. That in the news. For the rest, nothing really market moving. The only thing, but it's not even moving the markets, is the Bank of England has been looking closely at what happened on the SVB story and stuff, and now they are they're considering to push foreign banks to replace branches with subsidiaries, so they can have a better oversight and possibly an easier intervention into those subsidiaries legally than what they are now when they are branches. So, but apart from that, I mean, no, I haven't seen anything else than what you were already talked about.
Thank you, mate. Okay, well, we shall get stuck into some charts then. Going to start with dollar yen, and not an awful lot going on in a lot of pairs at the moment. This one sticking to its current battlegrounds between 144 and 145, or 144.90 and 144.20s. Really looking at this one, I think today is going to be a case of, and can be a typical reaction when the US has had a holiday. The market doesn't really know what to do, so it's going to wait until the Yanks come to their desks, and if they decide to make a move any which way, then everyone might jump on board and go with it. So for dollar yen, we're in a bit of a tight situation either way, 144, 145. It's not going to stay this way for long, so it's got to go one way or the other. But the longer it goes sideways, then the likelihood of an accelerated move if either of those two sides break. I'm still long a bit off that move earlier this week. I did a little jump in at the big figure down there. I've knocked it out up to 144.70s. Still a bit long, stops just below this line here. But yeah, I think we're going to need a move one way or another. And I'm tempted maybe to stick some buy stops in. I did have some buy stops in that I pulled. I might go back in at just above the big figure just to see if we get a break and it does motor on. Don't know whether we'll go with a sell stop below 144 because we know there's no real reason for this to come piling down or yen strength to come steaming in. So the dips I'm still expecting to be balled up, but we could get a break and move down to maybe 143.5 before the buyers come in again. As I say, going to wait and see what the US wants to do with things. Aussie dollar after the RBA. It had a little move down on the RBA going on to pause. It's bounced again, still more sideways action. We're mooching around this zone. Can't quite get back above 67s. So that's the level at the moment. On the downside, though, it isn't really looking like it's falling out of bed or wants to fall out of bed. So again, we're probably going to be playing, a bit of a tight range and then look to go potentially with the breaks. But I don't see any reason why we get a big, huge move here unless it's driven by some other factors other than what's going on in Australia. Obviously, the big US data day starting tomorrow could impact things depending on how those numbers drop. We have got a load of jobs as well, jobless claims, ADP, JOLTS, something else I can't remember, Challenger layoffs, that's the one, as well as the ISM. So that's going to be a big mover, I think, for tomorrow. But yeah, so far the downtrend from the 69s remains in place. We haven't really broken it. And we've got a bit of solidness around 66s, 6580s, that sort of area. So until we break down below there or get back meaningfully above 67, sideways we shall go. Cable still looking very sticky, 126, 128. That's really your area. We're mooching around 127s. Again, there's a lot of waiting in these pairs at the moment, not doing much at all. And if you are trying to trade this, you really got to have a bit of patience. Pick your levels. You don't want to get caught in the middle here at 127. If you think it's going down and then you end up, 127.5 near 128 again, you're offside. Conversely, if you're long here and you get down to 126.5, you're going to be thinking, what have I done? So, you need to widen your expectations, I think, or widen where you're going to trade this. And if nothing's happening here, don't do anything here. There's no point in trading something that's not really moving. I'm keeping an eye, as always, on euro sterling. I did think we may be having a little look lower as we came off the 86 area. Might get a look down towards those lows, but we're running trouble around 86.50 and bouncing from there. So another one that's still a bit of a mess in the short term and not really giving any indications either way of what it wants to do. Could say it's still in this downtrend, and until it gets above this 87 number that we've been speaking about a lot, then the downside may be more favorable still. I think still leaning that way anyway, and I'm still waiting to catch a knife if we get a move down to the low 85s, just to try that from a speculative point of view or a technical point of view. Euro dollar, We've got some big options off today at 109. So no surprise to see the price hanging around there. Nearly 3 billion going off the big figure 109. And yet another one that's not moving anywhere meaningfully for now. So what are you doing, guys? Are you strumming your fingers on the desk, waiting for some levels? Or are you getting involved in the middle here?
On what, the euro dollar or in general?
Anything general.
Well, actually, I can show some charts today if you want. If you are, whenever you're done.
We are blessed. Yeah, go on, mate. Do you want to?
Okay. Yeah, I'll take it. I'll take it now, and I'll show what I'm looking at. Hold on.
Yeah, I mean, on while Stell is loading it up, I think the euro is really that 109 looks like a magnet. You remember the 124, 40, 50 in the cable. 109 is now the magnet on the euro dollar, and we've seen moves that try to break above 109.35, 30.35, got sold into moves down to 108.60, getting bought. So we need to break that magnetic field around 109, and the next couple of days, the dollar data could do that easily. I think. I think on Friday, once we get the NFP out of the way, we should be at other levels. If we're not at other levels after Friday's NFP, then it's I think we can go on holiday for 2 weeks. Let's all go to Greece and to join Stell and Steve.
Please do.
I agree with that.
I want to be a buyer of the euro dollar. I agree with Bran and Mike on the chat there. You know, the whole situation in France, yes, they've been like this with riots and what have you for years now, right? So the market's a little bit numb to it, but if there's any kind of like proper escalation, I think that's probably going to spill over to the euro. Or if we get another strong print in the NFPs, this can definitely give a little bit of downside, but I really would want to be buying close to this support trend line, which is not close to here. It's like 160 pips away. So for me, the euro dollar and the Dixie is in the middle of no man's land at the moment. I'll get rid of this. Really 100.80 for the dollar, for the Dixie, and we have to kind of break above. There we go. We have to break above, 104 for us to be looking at, which is also a fib, the 23.6. So we have to break above 104 and change for us to say, yeah, this might be a proper move higher. So for now, I'm not touching those. The one I'm really looking at is the 10-year US, and we've been talking about this for ages. We are still hugging this resistance trend line. I think we are at the trend line now, but I think 390 to 4%, that's going to be really the big one. We may break above this trend line, but we have to go to those levels to really start looking at the potential move higher. It's not my base case scenario. I've said this before. I think inflation will keep printing lower. If I'm not mistaken, the next CPI, US CPI print, which is expected before the FOMC, it's expected to be like in the low threes. So if that happens, which I think it will, we've talked about it at length. Remember initially when inflation was at 9%, and I was saying, look, guys, end of first quarter, 2023, maybe towards second quarter, we're going to be seeing a lot lower inflation. Well, I was maybe off by a couple of months, but we are seeing it drop quite dramatically. And I tell you what, if we get 3.1, 3.2 or something like that, the Fed is going to be very happy with that. And yes, it's not going to be a target, but the direction is there, the pace is there. And I think if we do see that, the chances of the Fed not hiking in July is going to be rising. The market is pricing still 75%, 80% chance of a hike. So for the moment, the Fed would not, if they were deciding rates today, they wouldn't want to go against the market and shock it. But I tell you what, if the chances go 50-50 because of a lower CPI print, then I think they're going to probably be going on hold. Go on.
What would they do if CPI did come down that far, but core went up or stayed unchanged?
That's a good question. Core, people talk about core all the time. It excludes food and energy, right? And I think a couple of other things. Food and energy are the most important ones. So I have this trouble saying, oh, core is the important one. Well, how can it be the important one where you cannot live without food and energy? So I'm a little bit skeptical about the relative importance of core PC or core CPI. But you are right. If core starts going up, then I think that the headline CPI will not be dropping as fast. I think those two are tied because core cannot go up and the headline going down to 2%. So if core starts going up, that means that headline CPI is not dropping as fast as we want or the Fed wants, which means that they're going to be more hawkish. But last print, I think we saw core go down by 0.1 or something like that. It's going to be stickier than the headline number, but I think core is also going to trend towards 3%. Or 3 something. So anyway, let's see one day at a time. I can obviously not forecast what happens in 2 or 3 months from now. Nobody can, even though they'd like to say they can. You can, of course you can.
Yeah, the sun will be coming up. Okay. There you go.
Yeah. So my base scenario is that CPI is going to be dropping more, core grinding slowly lower, and that's going to give the Fed leeway to say, right, we're done for now. And I think if they say we're done for now, that's it for the cycle. Remember, they've done the first step, which is saying that they're going to be skipping. And I tell you what, if CPI comes in low, they're going to have a lot of reasons to stop completely. But going back to yields. So we are now at a pretty important level and we are trying to break out, but we're not. So for the moment, we are staying. If payrolls are strong, then this might get to 390 again, then we get into the serious decision because that's, if we go above 394%, then we're talking about a completely different situation. We're talking about inflation probably going higher than lower. And that then changes my whole kind of macro outlook. For the moment, this is what I think. But of course, I can change my mind if the data dictates so, dictates it. So for now, I think yields are going to be finding resistance. I think we're going to be dropping. And because I think inflation is going to be dropping, I think yields are going to go straight back down towards that 320 something low. And I think the higher chances that we break lower. I know I sound controversial when I say this, but this is what I think is going to be happening. Remember, most of the leading indicators in the US, in the Eurozone, the UK, you've been talking about them this morning, Ryan, they are turning and they are in contraction mode pretty much everywhere you look. And PPI is dropping. US PPI, okay, it didn't year on year, didn't peak at 40% plus like in the Eurozone, but it was something like if I recall correctly, 15 or something like that. So it was very high. Now it's expected, the next print's expected to be at 0 or going negative as well. So that will all feed into prices and feed into inflation. And remember, it's the rate of change, inflation, is not the level of prices. Prices are high and they will remain high, but the rate of change is going to drop. We will be very lucky if we get any negative inflation prints. I don't think we will, but to get to target, or close to, I think we're going to get there. And of course, the Fed's going to take that as a big victory, et cetera, et cetera. So yields going lower, what does that mean for equities? Well, I think that anyway you look at this chart, there's nothing bearish about it yet. So especially if yields go lower, then the knee-jerk reaction is to buy risk. That's always the case, almost always the case. So dips have been very shallow and they get bought straight away. My base case scenario is they continue to do that. Having said that, we are in very rich area in terms of valuations. So at some point we have to have a correction. What's going to cause that? I don't know. When is it going to be? I obviously don't know. If I knew, I'd be a trillionaire. So would I go against the S&P or even the DAX and NASDAQ, my God. Of course, I wouldn't go against it. I mean, NASDAQ is about to take out new highs, and that's bullish. I mean, any way you look at it. So even the DAX, which is dropping 0.5%, we're so close to all-time highs, it's not even funny. So we want to get below 15,600 or something like that for me to say, yes, okay, this maybe was a top now. But above that, higher highs, higher lows. the definition of a boom of a bullish move. So I'm not touching this to the downside. Would I be chasing it to the upside? Well, no, but if you ask me to do something on this, I'll be buying it. As simple as that. Even though it doesn't make any sense to me, I would be buying it. So talking about risk, well, we look at the proxies, cryptos. They are doing well. They had been underperforming for a while, but then we got that ETF announcement by BlackRock, and we just went whoop. 20% or 10. What is it? Yeah, 20% in a week. So that was strong, and this consolidation looks strong. It looks like we're playing with the previous highs. We're not above, but this looks like a bullish consolidation. So if I think risk is going higher, then these are now probably going to be breaking higher. I don't see, given that the sentiment has changed with cryptos, at least for now, I don't see how they're going to be underperforming equities now. So if equities go higher, I think cryptos break higher, and Bitcoin is at the level. Ethereum is not the same. It hasn't reached the previous highs. But if Bitcoin is rallying, will Ethereum sell off? Of course not. So they're going to be moving in the same direction, I think. Metals, well, this was a really nice retracement to 38.2, almost to the pip. Maybe it was the tip if I've drawn it properly, which I probably haven't. So this was a nice bounce of the 38.2. Gold overall, if you think about, I'm going to scroll back again and just look at the big picture. If you think about what central banks have done, what inflation has done, the tightening basically that we've seen, this is just a powerful consolidation. Any way you look at it, only a 38.2 retracement from the highs. I mean, this does not look bearish. Now, what do I think in the short term? It will depend on payrolls, inflation, and the Fed, obviously. I still think there's a chance we might get towards 1840, 1850, but this low, given that we bounced off this technical level here, it looks pretty solid for now. So I'm not bearish. I don't think it's more likely that we're going lower now, as I've been saying for a while. Remember from the 2000s, I was saying I think we're going higher eventually, but most likely we're going to see a leg lower first. Well, I think this might have been it. Famous last words, I know, the big data coming up, but I think this might have been it. And this is what I drew on silver. It came in. This was a level of an area of interest before this 21, almost 22 to 22 and a half. And we bounced very nicely off that. Okay, it's not a very powerful bounce, but it is there. And we now wait for the US data. So was this the low? It could well be. I am still long. I'm about 15 cents offside or so. I should have, initially I was talking about 22s to add. I didn't. I got a little bit scared by the force of this move lower, but I'm still holding those longs, and I will be adding more if we see like a proper leg low from here. I don't know if we're going to get it, but I am still holding that position and feeling very comfortable with it. Oil, I don't know how you guys trade it, but it seems to be like. Sorry,
we don't.
We don't. Yeah, I don't. I haven't traded.
What do you want to do? What do you want to do here?
I don't know. This is like a sideways chop
exactly.
every single day. You have OPEC who keep telling us, well, we're going to do whatever it takes, or I don't remember how they phrased it. So you live with the danger, if you're short, you live with the danger of a headline that, squeezes you out completely. On the other hand, the economic environment is deteriorating globally. So theoretically, we should be breaking lower as demand drops, but I don't know what to do with this. Sorry, I have really no clue. Let's look at a few currencies. We looked at the euro dollar, euro pound. I have the same view still. Anything below 87.2 and it's still bearish. Ryan is talking about the low 85s to get long. Yeah, not a bad place actually if you want to try it again. But what do I think is going to happen? I think we're going 83 and a half eventually. And this is because we are seeing higher inflation in the UK, higher wage growth rates, higher everything. Of course, we're seeing contractionary PMIs there. Actually, no, we didn't. Today they were good, right? They were, there you go, 52.8, 53.7. Not too bad, not too shabby. Well done, UK. So I think I'm still a buyer of the pound. I like it, and same with the cable. It's well, look at this chart. Do you think it's bearish? I don't. I still think this is, yes, it's not flying away, but I think it's still looking relatively strong. And given my idea or projection that the dollar is going to be weak going forward, this, I think we're going to break above 128.5 and go towards the 30s. That's what I think is going to happen. So I'm bullish the pound. Yeah, end of story. Norway, we are seeing something like a head and shoulders. What is that? Something like, where is it? Brush, does that work? Get rid of that. You can all see what I'm looking at, right? So you have that. But there's a long way to go.
You copied my head and shoulders now. That's disgraceful.
Did you show that? Okay, sorry about that.
Mate, you carry on.
So this is something, and if this breaks, then you're making new lows as well. This is going to be powerful, I think, if it breaks. So, I tried a couple of times to short Euro Norway and dollar Norway, got burnt on both times. Thankfully, my stops were very close, so it wasn't a big damage. But I want this to break before I get in. Dollar Norway, similar stories, not as clear. These lows have to be taken out, which coincide with this trend line, which is a big ass trend line. So a break below, 1040 something. I'm going to look at that with interest. The yen, I haven't traded in ages. I don't know how you guys do, but this does not look like it's turning yet. So very careful if you're trying to get long yen. So short XXX yen pairs. I mean, there's nothing yet to say that this is turning, and the Bank of Japan is still stubbornly not hawkish. So I would suggest go against your natural instincts to try and find tops and bottoms in everything. This is what humans do. My first mentor said to me, trading is probably one of the most difficult jobs in the world because you have to go against what you're hardwired to do, which means, you want to be the hero. You want to call the top or the bottom. And also when something goes right, you want to take the profits quickly, and something goes wrong, you want to say, let's wait, it's going to turn. No, you have to do the exact opposite. So we have to be disciplined. Okay, we could talk about this for hours. I'm going to stop. Yeah. That's it, I think. So
Thank you, mate.
Just a broad overview of what I'm looking at, and we wait with eagerness and anticipation for payrolls and then inflation and the Fed.
Cool. Right, if you want to pass the baton to K-Man, I'll just answer Mike's question. Do I believe the pound will be more resilient to USD strength than the euro? I think it's a case of context. There's two ways you always got to look at the pound and the euro versus the dollar when the dollar's moving. Cable is always going to move more than the euro. So if the euro drops 30 pips because of some US data, cable's probably going to go 50, 60 pips. The same on the other side. If the data's bad, then cable's going to rally 60 pips. The euro might rally 30 pips. There's always that different volatility difference between the two pairs. Hence why you need to look at something like euro sterling, because it can present opportunities when that happens. If cable moves more than euro dollar on some US news, you're going to see euro sterling moving because it's going to reflect that volatility difference. So if there's no fundamental change between UK and Europe, then potentially that's a trade for euro sterling to revert back to the mean, if you like, after that volatility's come out. But in terms of the fundamentals, it's going to be about soft landings, recessions, who's going to be the cleanest shirt in the laundry basket again, and that's going to play into whether cable is more resilient than the euro. If the eurozone heads to a steeper recession than the UK, if the US is going for a soft landing, then obviously cable is going to probably do better than the euro dollar. So right now, I tend to look at things with a longer term trading aspect. I like to look at things 6 months, 9 months, 12 months down the line. I don't see any big trends forming that I'm prepared to get on right now and say I'm happy to trade this for the next 9 months. It's really all about how things are turning out over the next few months, and that's what will give you my trades, I hope. But yeah, so for that resilience, it's all down to who does what in what country and how that's going to impact economies and central banks. Over to you, Mr. K-Man.
Yeah, thanks, Ray. I'm just going to look at a couple of pairs because I don't want to spoil Stelios' valuable contribution here.
The value is zero. How can you spoil it worse? Right? It's down to zero.
Okay, on the Aussie, first of all, I'm going to look at a few dollar pairs. My overall view on the euro pairs, though, is that they are gradually losing steam. We had the end of June where we had a clear buying bias in euro crosses. We have seen the euro antipodians, euro Canada, euro yen, even euro sterling was going up a little bit again. Euro Norway, etc. And we're seeing a bit of a turnaround here at the start of the month of July. I'm actually trading a couple of them short again. Obviously, I always like when I'm in a position to have a little bit of carry for me. So one of my pairs of choice is Euromex, but I've also been trading Euro Kiwi a little bit because the Kiwi was doing better, especially since the start of the month, also doing better against the Australian dollar. So I'm still looking at stuff right now. I don't have much running, barring the Euromex on the cross side of things. But let's look at a couple of dollar pairs for the next 2 days, because we are going to have a slew of US data out over the next 2 days. Ryan already summed them up with a cherry on the week's pie coming on Friday with the NFPs. And in response to CPI watching, I and people listening here know. For a while now, I've been saying, like, let the real data stand up and tell us where we are going to go. And I think as CPI gradually comes down, of course, there's going to be different speeds in the US versus the, for instance, the European continent. And we have to know that a central bank like the Fed is always been historically more dynamic than a central bank like the ECB, and we've seen it again in this pandemic round. So it may be that the Fed is going to be faster to react to lower CPI prints, but I do think that we have to have a close look as well on the other data, and one of those data is going to be, and we have like 2 or 3 numbers who are going to show us what's going to happen. One first on the PMIs, on the services PMIs, and then of course on the labor market, and the labor market being one of those big dominoes that I've been talking about for months now, saying like, well, this is really holding up. If we ever see that start to falter or start to show weakness, then I think there may be a real problem for the dollar. And if you look at what the stock markets can do, I think a weak labor market or weak real data, of course, inflation is a real data point as well, but I'm saying the other one, which are measurable as well, is that I think that may actually weigh on the equity markets after an initial drop in yields. They could actually weigh on the equity markets if the rest of the data, especially the labor market, starts to falter. There, I said what I had to say. Aussie dollar, I think the effect of the RBA is a bit out of it now, especially since they paused. 2 levels to watch to the downside, I think, for the next couple of days. The first of all is the 66 and a quarter, towards 66 the figure, and then here the other one, 65, 85, 90. Those 2 are going to converge on Friday. They will be a lot closer together. So they will be 65.90, 66.10 zone. This is going to be very important on the Aussie come Friday. And on the top side, 67.2540 is still a level that I'm really watching, because if we get back above those levels, we can see that they've been traded every time we went up there. 67.2540 is a level that where if the Aussie goes up above there, I do think there's an issue with the dollar, if you get what I'm saying. So those are the levels here. The one that is much more dynamic right now and much more trading positively is the Kiwi. And just have a quick look at this Aussie Kiwi. Look at what Aussie Kiwi did since actually the RBNZ. Since the RBNZ did what they did, the Kiwi is having a lot more power. That's also some of it having to do with Chinese yuan weighing on the Aussie probably. But on the Kiwi, there's two levels here that I'm watching right now. Is 61, around 61.5, and then here this one around 61.40. I think those are the two levels of support. If the dollar regains some strength, those have to hold, or it's the end of the party and we go back down. If in turn we are going to get slower US data, first little level here is going to be 62.25, but especially if we get back above 62, call it 40.50, then I think we may actually have the start of a much more powerful move. On the other side as well, if we would get a bit of a test here and then we start to move higher, that would also be a show of strength in the Kiwi. And if you look at stuff like Euro Kiwi, for instance, we are seeing this Kiwi strength as well. So that, in case of the rest of the currency showing a bit of weakness, I've got the impression that the Kiwi is one of the currencies that could actually continue to do very well if we get weakness in the rest. Okay, so that's one of my correlation trades that I'm looking at. We can see here we broke this trend line. We broke below here. Okay, this is now we're hovering around here. Keep an eye on what's happening at 176 on the Euro Kiwi. If we start to cap that again, and we start to move lower again, then you're also going. That should support the Kiwi dollar as well.
Just before you flick off, mate, I don't trade it an awful lot, but that Aussie Kiwi, if you look at it a bit wider, like a 4-hour or something, that 108 level is another cable 24.50 and another euro dollar 109.
Yeah, absolutely, mate. Absolutely. We recall that from prior levels. I think I even have it on the date. No, you know, we had problems with I had problems with my trading view stuff.
Yeah, it does go back quite a way, but it's more prevalent this year. You know, we always seem to be back here at some point.
Yeah, it's probably yeah, I don't have it right here, but I know we spoke about this 108 level on the Aussie Kiwi as well. I remember that indeed, and I will need to sharpen this up a little bit. But I think this time it's 107 and around 107.5, and we are on the approach, right? Trading 107.70, lost 3% over the past couple of weeks, and we are now probably in a bit of support zone here, but I don't know. I mean, Aussie still doesn't look too bright for me. On the contrary, Kiwi is looking pretty cool right now. But we are in this 61.85 figure zone, and remember we were talking about this 61.90 figure every time we came here as well. So here we are trying to go to make up our mind, and I think our mind will be made up in the next 2 days. Dollar yen the same as both Ryan and Stelios already showed. This trend line here has been hopping around, but now it's starting to get a bit too close to the market. But I would keep an eye on what's happening at 143.5 and 142.5. If we get back down on weaker US data, keep an eye on what's happening in the 142.5 zone. On the top side, of course, I mean, it's a no-brainer. 145. If we break back above, then I think there's another 150 to 250 points to go to the top side, and then we're probably going to run into MOF comments again. But let's not forget, if the rest of the dollar strengthen without really the crosses in the yen strengthen too much, there's very little that the MOF will really manage to do. Yes, we will have those 200, 300, 400 points declines if they intervene, but if the dollar continues to strengthen versus the rest, I don't see how they can keep it down, because we are going to run into fresh yen sellers on interventions if the MOF really goes against the trends. Remember, back in the in those interventions, we had those interventions from 146, but then since the dollar was strengthening, there was nothing they could do. So it's here. Those are the first interventions. There was nothing that the Bank of Japan or the MOF could do. So that's when we rallied up to 152. Then they intervened. Then they intervened again. This drop here is probably they intervened again, but this is US CPI starting to weaken. This is not only due to interventions. And that's where dollar yen could start to go down. And then we had all those Japanese accounts selling US Treasury, US bonds and stuff, getting out of their bond holdings, which then brought us back to the lows. But since then, the picture has changed somewhat. We had this hopium on Ueda, but then Ueda started by saying, well, I mean, it's probably not going to be plain sailing here in Japan for us to start changing our monetary policy. So again, overall on interventions, yes, they can intervene, but they need to have the market on their side for it to hold, okay? So that's the little thing about the dollar yen. But those are the two levels, 140, just above 145, 142.5. I think that's the band. If either of those two sides break, then there's going to be bigger moves. That for the dollar yen. I think I'm going to leave it there. I think that's low enough for now. Yeah.
Thank you, mate.
Awesome. Well done.
Thank you very much. Well, before we shut up shop, I just want to remind everybody that we have our NFP competition up and running. I will put the link to the tweet in here, but you need to go and check out the blog post attached, because we have an extra special prize this month. We are giving away a $50,000 traders funding assessment as first prize for this month's competition. So check that out there. That will also give you the free time on the ForexAnalytix platform. We do still have 2 other prizes of a free month. So even if you don't get the top prize, you can get the second and third prizes. But yeah, follow that tweet link there. But do check out the blog post attached for all the terms and conditions on that. Have a crack, and we'll see you all bright and breezy tomorrow for the big day today. Thank you very much to who should I go first? Kay and Stel. I'll do it that way around today.
Thanks to Steve, first of all.
Thanks to Steve. Yes, thank you, Steve. Thanks, Steve. And yeah, we shall see you all tomorrow. Have a great day, everybody. Cheers.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.